Name is William Taipan William. The topic I want to talk about today is, the second series of the central government of China releases capital to save the market, success or failure, and the theme is, don't enter the financial bubble of the century. In the previous episode, we said that the central bank will invest 2.4 trillion yuan in currency to promote the rise of the capital market and the stock market, and pull the market to save the economy. But this means is actually impossible. This is a mismatch involving resources. Money does not really enter enterprises to solve practical difficulties, but many major shareholders will reduce their holdings, foreign capital liquidate, and speculators, financial crocodiles left the market for profit, and the youth borrowed money to speculate on stocks, resulting in the ups and downs of the stock market. But it was very volatile and lively. But there is concern behind it, indiscriminate issuance of money, common accounts, social innovance, and mass investors are tracked to attract losses, which instead affects consumption and financial stability. Recently, many scholars and professors have come out to speak one after another. China can also issue multilateral bonds, and issue up to 10 trillion yuan of government bonds to increase financial support, and the upper limit of the fiscal deficit to the proportion of gross domestic product, GDP, can be raised from 3% to about 4% this year. The Ministry of Finance also came out to talk about measures such as issuing new bonds to exchange for old bonds, exchanging long-term bonds for short-term debts, exchanging government bonds for local bonds, etc., believing that all problems can be solved by the power of the capital market. Can this series of measures to release water, cut interest rates and raise debt effectively solve problems, and save the sluggish economy and the real estate market after the explosion? I think the intention is good, the method is wrong, and the consequences are serious. It is likely to create a century financial bubble and trigger a crisis. First of all, let's analyze the value and asset security of RMB and US dollars. First of all, let's analyze the substantial value of the RMB and the US dollar, as well as the monetary security and the financial support. China is the world's second largest economic system. China's GDP in 2023 is 17.8 trillion US dollars, while the United States is 26.8 trillion US dollars, which is about two-thirds of the total economy of the United States. China's total currency issuance is about 42 trillion US dollars, while the United States is 21 trillion US dollars. That is, China's total economy is about two-thirds of the United States, but the currency issuance is twice that of the United States. You can see the difference between the GDP support behind the currency issuance of the RMB and the US dollar are large. Let's take another look. Compared with GDP and currency issuance, China's currency issuance is 2.4 times the annual GDP, while the U.S. currency issuance is only 0.8 times that of GDP. In terms of the economic situation, we can see that the issuance of our RMB is 2 times more as much as that of the US dollar. Let's take a look at China's gold and foreign exchange reserves. China's gold reserves are about 200 billion, while the United States has 5 trillion equivalent gold reserves, which are about 25% of the gold reserves for the currency they issue. Compared with the currency issuance, China's gold reserves are actually equal to 0.48%. So it is much lower in relative terms. China has 3 trillion US dollars in foreign exchange reserves. We calculate the sum of gold reserves and US dollar reserves, which is about 3.5 trillion US dollars, about 7.6% of the money issuance of 42 trillion. However, the US dollar is supported by 25% of gold reserves. The RMB is relatively weaker than the US dollar, and its strength and value are only about one-third in terms of the size of the economy and the support of gold and foreign exchange reserves of the currency. The total amount of currency issued by the RMB relative to the US dollar has actually 2 times more. If we print banknotes again to increase currency issuance and raise debt, it will further weaken and impact on the overall financial soundness of the country, forming an extremely large problem and bubble risk. Like a timed bomb, in the past, the interest rate of the US dollar was low, the interest rate of the RMB was high, and the excessive issuance of RMB could also maintain stability. However, In the past year, the interest rate on the US dollar has risen sharply, and has remained at a high level, about 5%, while the interest rate on the RMB has begun to decrease, almost half of the US dollar now, about 2 to 3%, so the value of the RMB itself is relatively weak, and further adopt a low-interest policy, which further reduces the attractiveness of the RMB, investors will sell RMB or RMB assets, and transfer currencies to those with high interest rates and reserve support, forming the transfer and outflow of capital and funds. This directly affects the stability of the entire RMB, further depreciates the RMB, and affects the stability of the entire Chinese financial system. 2. The issuance of additional currencies and the issuance of large-scale debts will cause the following problems. 1. Inflation rises. When there is too much money supply, the price of goods and services will rise, leading to inflation. This will reduce the purchasing power of the currency. 2. Economic instability. Inflation not only affects the consumption decision-making of individuals and enterprises, but also may lead to a slowdown in economic growth, and even an economic recession. 3. Losing trust. When the government, or the central bank issues money indiscriminately, public trust in money will decline, which may lead people to turn to other more stable assets, such as foreign currency or gold. 4. Mismatch of resources. A large amount of liquidity may flow into projects with low return on investment, resulting in a mismatch of resources and further affecting economic efficiency. 5. Intensifying social inequality. Inflation usually affects low-income groups because their real purchasing power declines, while the rich may benefit from the appreciation of assets, leading to a widening gap between the rich and the poor. 6. Aggravation of the external debt burden. If a country issues currency indiscriminately, it may lead to the depreciation of its currency, thus increasing the foreign debt burden denominated in foreign currencies. 7. Capital outflow. Investors may withdraw funds out of concern about inflation and economic instability, leading to capital outflow and further weakening the economy. 8. Raising interest rates. The issuance of a large number of government bonds may depress bond prices, push up market interest rates, and affect the borrowing costs of enterprises and individuals. 9. Credit rating downgrade. If the market believes that the national financial situation has deteriorated, it may cause credit rating agencies to downgrade their ratings, and further increase borrowing costs. 10. Financial sustainability issues. Long-term dependence on government bond financing may lead to the intensification of the fiscal deficit, affecting future fiscal policies and social expenditure. The formation process of financial bubbles can usually be divided into the following stages. 1. Early stage, innovation or development. The emergence of emerging markets or new technologies, or new government policies attracts investors' attention and leads to capital inflows. This may be due to some economic or technological breakthrough, such as the internet, real estate or emerging industries. 2. Optimism, speculation. Investors' expectations for the future became too optimistic and began to invest heavily to promote the rise of asset prices. Positive media reports and successful cases further stimulate investment enthusiasm. 3. Price increase, excessive speculation. With the influx of more funds, asset prices continue to rise, forming a herd effect. Many people start buying not only for practical use, but also for profit. 4. Excessive leverage, risk accumulation. Investors may borrow money to increase the scale of investment and further push up prices. This leveraged behavior increases the vulnerability of the market. 5. Reach the peak, foam formation. The price of assets has reached an extremely high level, far exceeding its intrinsic value. At this time, the market is full of speculation, and many people think that the price will continue to rise. 6. Turning point, bubble burst. Once market confidence is shaken, or negative news, such as poor economic data, policy changes, etc., appears, investors begin to sell, and prices fall rapidly. 7. Collapse, market adjustment. The price plunge has caused a large number of investors to suffer losses, and many lone investors may face bankruptcy. The market entered the adjustment period, and the asset price fell back to a reasonable level. 8. Consequences. Economic impact. The bursting of the bubble may have a wide impact on the economy, including the credit crunch, the decline in consumption, and the decrease in corporate investment, which may trigger an economic recession. Understanding the formation process of financial bubbles helps investors better recognize risks and make wise decisions. There are many famous cases of financial bubbles in history, and the following are some important examples. 1. Dutch tulip mania, 1636–1637. It is considered to be the first recorded financial bubble in history. The price of tulips soared in a short period of time, and many people bought them speculatively. In the end, the price collapsed, causing heavy losses to investors. 2. South China Sea Bubble, 1711–1720. British South China Sea Company issues shares, and promises to make profits through trade. With the increase in speculation activities, stock prices soared and eventually collapsed in 1720, and many investors went bankrupt. 3. Mississippi Bubble, 1719–1720. The French Company of Mississippi promises to profit from colonial development and attract a large amount of investment. The bubble collapsed in 1720, causing heavy losses to many people. 4. U.S. Stock Market Bubble, 1929. Due to speculation and excessive leverage, the stock market experienced a rapid rise in the 1920s. The stock market crash in October 1929 triggered the Great Depression, which had a wide impact on the global economy. 5. Japanese Real Estate Bubble, late 1980s to early 1990s. Japan's real estate and stock markets have experienced huge price increases. The bubble burst in 1991, causing the economy to stagnate for a long time, which is known as the lost decade. 6. Internet Bubble, late 1900 and 2000. With the rise of internet companies, investors' enthusiasm for technology stocks has risen and stock prices have soared. In 2000, the bubble burst, many technology companies went bankrupt, and investors suffered major losses. 7. 2008 Financial Crisis. Excessive speculation in the real estate market and the subprime mortgage crisis led to the bursting of the financial bubble, seriously affecting the global economy. Many financial institutions have closed down, and the government has to rescue them. These cases show that financial bubbles are often closely related to excessive speculation, overconfidence and market sentiment, and their bursting usually brings serious economic consequences. At present, the China Central Bank is printing more banknotes and releasing water, urging the grain stock market, reducing interest rates, issuing debt in a big way, increasing leverage, and increasing the deficit ratio. It is expected to use the power of capital to save the economy, but the practice is a little confusing and out of reality. Debt issuance is to tighten the liquidity of market funds. Issuing more currency and reducing interest rates will further weaken the RMB and the outflow of capital. The urge and grain stock market is even more high risk, and the effect may be counterproductive, causing a century financial bubble, and then triggering a national financial crisis. I hope that the central bank will learn from the lessons of history and the bursting of the real estate bubble in recent years. Think about it before acting. Adopt a stable financial management method, and take the right medicine to ensure the well-being of the people. Today's analysis and awareness of the financial bubble and crisis ends here. Next time we will talk about the solutions to China's real estate bubble bursting. Thank you for listening. Please remember to subscribe, like and share. Thank you, everyone. Bye.